Hi, everyone, and welcome to the TimingResearch.com Analyze Your Trade, episode number 115. This special episode on Monday, February 24th, 2020. My name is David Kosmeter. I am the creator of TimingResearch.com, and today we will be discussing your trade ideas. So I have arranged for John Thomas and Jim Kenney to join us for this special episode, and Jim will be moderating, so I'm going to go ahead and turn it over to Jim.
Okay, thanks, David, and thanks everybody for being here. A very exciting day out in the market, and we've got 15 stocks that you guys have submitted. After we go through about half of them, I'm going to let our guest, John Thomas, go over some of the things that he's doing so he can share that with you as well. Before we get started, we'd like to, obviously, for the new people coming on board, introduce John Thomas to us, and again, what John's doing up there at his company. So, John, a little quick background on yourself and what you guys are doing up there.
Well, I've been playing around the market for a little bit more than 50 years now. Used to be the head of trading at Morgan Stanley, ran a hedge fund for 10 years, and have been running the Diary of a Mad Hedge Fund Trader for 12 years. We are running an average annualized return right now of over 33%. And we are loved and adored in 136 countries. We do global long, short, macro, all asset classes all the time, long and short, stocks, bonds, foreign exchange, commodities, precious metals, energy, and real estate. And there is always something good to do. That's what we believe, and I hope you'll see some of our tricks in the following hour.
Okay, and at the end of the broadcast, of course, you can explain how do people get a hold of you at the end, so you could share that with you as well.
Okay.
Before we get, as we get started here, the first stock is obviously one of the most volatile stocks in history almost, and basically it's Tesla, TSLA, and obviously market cap is now more than double GM and Ford, so this thing is certainly taken off like a rocket. What's your view on Tesla at this point, John?
Don't touch it with a 10-foot pole unless you're willing to keep it for 5 or 10 years. As a trading vehicle, it's become the next Bitcoin. Technical analysis is useless. Fundamental analysis is useless. The stock has gone nuts. And you see a couple of these every decade. We had a lot of these in the 90s during the dot-com bust.
Right.
We recommended the stock at $16. Yes, that's 1.6. The last entry point we had was in June at 180. We took everybody out at 390, got a double there. And since then, we've just sort of sat back in awe and watched the stock more than double over a very short period of time. So untradeable at this point, but go drive the car. I'm on my third Tesla now, and I love it.
It had a big breakout point above 400 this year. Would you think that if anybody was interested, maybe if it got a big breakdown towards those numbers, it might be more reasonable?
Hey, if you got this thing at the old breakout point, which is 400, that would be a gift from heaven. So absolutely, I pick it up there. And that's what I'm telling all my clients to do. At some point, this parabolic move will burn out. The natural regression point is back to the 200-day moving average or the 50-day or the breakout point, which is just below 400. So yeah, that's your entry point for Tesla if we ever see it again. But if it printed 1,500 tomorrow, I wouldn't be surprised.
Yeah, it's that kind of market, feast or famine or whatever it wants to do.
Well, and we think the company's going to take over the biggest chunk of the world car market within 10 years. They're so far ahead in technology, moving ahead every month. My car upgrades itself every month, just like any app does, like, Office does. So, yeah, nobody is even in the right ballpark except Tesla. And they're building factories now as best they can. They can get all the free capital they want to build these factories. That was an issue a couple of years ago. It isn't any longer. By the way, you look at this chart, it's a classic example of the longer you build the base, the bigger the breakout. That's exactly what happened this time. So Nothing else to say other than the
Yeah.
stock, other than Elon Musk is a difficult guy to get along with.
One of the catalysts for the breakout was the enthusiasm about the Shanghai plant that they made. And you would think with all the virus talk that enthusiasm would go away a little bit faster than it has.
It's
So,
not.
yeah, but it
And,
hasn't.
the Shanghai plant was in the works for over a year.
Right.
And they said, we're going to finish this factory in a year. And nobody believed them. But this turns out to be a country where you can build a hospital in 6 days. So
Exactly.
they brought it on stream faster than expected, announced the Cybertruck, the Model Y, and just hit the market with an onslaught of, good news. And after that, it was off to the races. The really curious thing about this stock is it still has a high short interest. And what's been happening is short players would get margin calls, get stopped out of their position, and then reestablish the short. They would put it on again, stop out again, stop out. And that is why you have like a double in such a short period of time.
Right. Well, the next one here is typical of many tech stocks in that they got way away from their 200-day moving averages, very, very, very extended. And now with some news that's not that robust, it is starting to gravitate back towards those averages, although they're still way above them. Here we have Apple down hard today, $13, been coming off of 327 now for the last few days. What do you think here on Apple? Further to go down, or longer term, it's a good place to be?
It just got so overextended to the upside that, you'd think that it would have to pull way, way back to bring any real long-term investors back in. 50-day moving average, 234. That's more than $60. 200-day moving average has to drop by half. And, I just don't see Apple dropping by a quarter or a half in the run up to 5G in September. So this may be a situation where you see the thing move sideways in a narrowing range until the averages catch up with the stock price, and that's your sideways correction. If that's the case, then next time it visits 290, that may be a buy, especially if you get something like a 270, 280 call spread against a 290 bottom. So that may be tradable, but only on the best days.
And with the 5G, obviously that could be a big boon to their revenues and their earnings. So that could even put the highs in jeopardy over time.
Well, and it's not just Apple that has a boom on 5G. It's everybody. The entire global economy goes berserk when 5G happens. And, customers have been asking me, why would I need a, 10-fold increase in speed? Everything is so fast now. And what tech does is you create the product and the customers come. The customers figure out how to use 10 times faster bandwidth, and then they create their own markets. That's happened with every technological generation that I can recall. And, 5G will be no different.
Yeah, because 10 times faster than a second or two is not really something that people would jump out at until they figure out how to use it and make it effective, right?
Well, it'll mean downloading a 2-hour movie in 10 seconds instead of 2 minutes.
There you go.
But, you create an app that eats up bandwidth like crazy, and that's what apps do over time. Real markets emerge, and, maybe we'll get 3D movies. Who knows? Maybe we'll get Star Trek type teletransporters. That would use a lot of bandwidth.
Yeah. And this is in
It's
every
also,
index.
I think it's also an issue of like capacity and range for the signal and, energy use. So the like the Internet of Everything. So you can have your refrigerator connected to the internet and
there's a lot
self-driving
of stuff that's already
cars
been
and
invented that won't
sort of
work until we get 5G, and autonomous driving is one of those.
Right.
Yeah, exactly.
Well, this next one here, you would think would do well in Asia since nobody can leave their house. This is Netflix, and it's down today as everything is, about 3% or so. And It's at 369. How do you feel about Netflix here? A lot of expenses coming out of their content, but also a lot of subscribers.
Yeah, I'd be a seller of Netflix here. At best, it's the top of a wide range. Everybody's eating their lunch. You got Disney Plus, you got
Yeah.
Apple Plus. Everybody and his brother is piling into the streaming area after Netflix essentially owning it for 20 years. So
Right.
Netflix is kind of looking like last year's buggy whip maker. Don't want to touch it. Rather buy Disney on the dip, and we're getting a hell of a dip here in Disney because it's being dragged down by theme parks.
Yeah,
If
I
you're worried
also
about
heard about Disney.
coronaviruses, the last thing you want to do is wait in line in China.
Right, right. I had also heard that Disney is actually trading below the price it was when it came out with the Disney
Disney
streaming and
yeah,
all
that's
that.
correct.
So from the standpoint of value, a lot of people are thinking this price is pretty darn good because you're getting it lower than it was when it came out with that new product.
Right. The problem with the whole market, though, is nobody knows if the next tick on the Corona chart is an up or down tick.
Yeah.
If it's a big up, we get a couple more countries. We could get another 1,000-point down day.
Yeah.
I mean, the market is overbought enough to accommodate a move like that. So
Yeah.
I'm 100% cash now and doing nothing.
There's a lot of air between the breakout point of 3030 and 3400 that's getting filled in.
Yeah, there's a planet's worth of air over the moving averages right now.
Right. All right. Well, Netflix to you is a basic either scale back or
I'd be a seller here if anything.
Or just a seller. Yeah.
Yeah.
Now this one, I mean, obviously, if you look at the daily volume, it seems like Tom, Dick, Harry, and every relative trades it. I mean, the darn thing trades as much volume as I've seen on anything. 85 million shares today. Advanced Micro Devices, AMD. This is another one that was way above its moving average, but again, now it's starting to close that gap, down about almost 8% as on my screen showing, and $49. What are you thinking here on AMD?
Well, this was sort of the poster boy for what was hot. There are basically only three big chip stocks in the world, and AMD is one of them. And essentially all technologies going forward need 10 times more chips than they have now. So it was a no-brainer. We actually got into this thing at like, $10 a couple of years ago and have been in and out of it ever since. And same is true with the other big ones, NVIDIA and Micron Technology. They all basically move together. So again, fantastic thing to buy it on a bottom or do a leap on a bottom, a long-term option spread. Up here, I'm scared to death, and we haven't been involved in the chips for a couple of months.
Yeah, the ETF on the semis, SMH, definitely gapped down hard here today. So, a lot of people think what gaps down goes down. So be catching a pretty falling knife type situation, stepping in front of the semis right now, huh?
Yeah, this was the most overheated of the overheated sectors, and
right.
Down 20% at the opening, or down 10%. Ouch, and that's why we haven't been at these things are just way overdue for a correction like this.
Right. Well, the next one here is another big news company because of all the problems they've had with the FAA, et cetera, and this is Boeing, down 12 today. It's still holding that 300 number, but a lot of people think that might get taken out and you might be a 280 buyer on this thing when all is said and done. What do you think of Boeing right here?
We actually, boy, if I can get this chart up. Doesn't want to show charts anymore, so let me try it again. Do this one.
Volume about 6 million today.
Yeah, we actually have traded in and out of this about 4 times in the last year. Let me get you the 2-year chart up because that's the only one that makes sense. I happen to be a commercial pilot. I'm rated on all the Boeing planes, so I know a little bit about the industry. Come on, there we go. And you can see for the last year, ever since the problems came out, that we've had this incredible chop between 300 and 400. And we've been trading that from the long and the short side all year. That last meltdown to 300, we bought it at like 305, caught the run to 340. We're out of it now. I think that'll continue. You know, this is, in normal times, considered the best run manufacturing company in America. It counts for 3% of GDP. It's a huge portion of employment. And this thing isn't going away. So once you get through all of the 737 MAX problems, you end up with an extremely cheap company with the best stock buyback history in the world, best dividend history in the market, that has a 10-year order book. So a gift anywhere around 300 is a gift. Pick it up there for the next run to 380 or 390. So I'm bullish on Boeing, especially down here. And it actually held up pretty well today, only down 4% in the worst day in 2 years.
Yeah, it is startling to see all those planes just sitting in parking lots, huh?
It's not a great recommendation to rush out and buy the stock, but when they lift the restraints off the deliveries on those planes, and most of those planes have been sold, just can't be flown until they get recertified.
Right.
Then you'll have an easy move back up to 450 or so. So there's a 50% move in this stock, provided you can handle about 10% worth of downside. It's probably one of the best buys in the market right now.
And again, because it is a two-horse race in the industry, and that's there's not many industries that can say that.
It's a duopoly, and there's just with Airbus, there's just no way that Aeroflot, which is the only other large aircraft maker, is going to threaten their position anytime soon.
That, and if Trump gets reelected, he's going $700 billion a year into the military, and Boeing has a big tower down there in Washington, just striking deals every day down there.
I'm not sure how much of that will go to Boeing. I think more of that money will go to defense companies in red states like Lockheed Martin and so
Northrop
on.
Grumman and those kind of guys.
Yeah.
All right. Well, the next guy is the other big poster boy for this market, and that's Microsoft. Again, another 5G play, and also another obviously outstanding company. Just been going up, and up for a long time now. But today was down about 4% at 170, and the volume was 68 million shares. So a lot of people were getting out today. What are you thinking here?
Again. At the 200-day moving average at 144, this is a real screamer on the long side. We're kind of in the middle of the new range, which is 190 to 140, say. So you get to the lower end of that range, it's a buy, unless they cure coronavirus tomorrow.
Yeah, and 163 area or so is the 50-day. So that might be an area to see.
166 is the 50-day.
Yeah, so that would be something to keep an eye on at that number, because it doesn't take too long to go from 170 to 166 or something like that.
Yeah, it got to the point where if you didn't own Microsoft as a portfolio manager, you got fired. So a lot of people in this stock, still a lot more trying to get in.
Yep. Last one before we hear some of your ideas here is going to be Roku. And Roku is another one that's had a wild ride. In the last 52 weeks, the thing's been at 55. It's been at 176. It's now at 116. So if it was driving on the highway, it'd probably get a drunk driving citation because it's all over the road. But right now, we're right kind of in the middle a little bit of the two numbers. What are you thinking here at 116 on Roku?
Well, we got into Roku at 25 to 30 range and really haven't touched it since it went over 100. So we've been kind of out of the game on this one for the last 6 months. Too risky, too volatile, and don't want to touch it up here. We'd rather look for the next Roku rather than to buy the current one after it's gone up 600%.
And that 100 number, that's been pretty good support
Yeah.
with the momentum turning down on 16 million shares. That might not be a very safe support level.
Yeah, if you can get down to 100, then you've got a double bottom play, maybe setting up a sideways channel. That may be worth doing, but you're still up 400% from the low a year ago. So again, it's a great idea that had its run
Right.
and appears expensive with a lot of other technology.
Hey, one last one here, because we did mention it earlier, and it is, like I say, well, what I've been told anyway, I don't know for sure, but it's been put down to a price that it was at when they announced their offering on that service. 133 is Disney, and
Yeah, sure.
what DIS? What do you see here? Because on a longer term basis, people seem to like it, but on a shorter term basis, there's a big gap between about 120 area and about 125, and there's some support down there at around 127. So do you
Well,
think we can
full
take out
full
127?
disclosure here on my age. I went to Disneyland on opening day in 1955, and Walt Disney shook the hand of the first couple hundred entrants. We had tickets because my dad was the supplier to the company.
I got you.
So I have been following this for a really long time. And again, one of the best run companies in America. Um, Disney Plus is going to kill it. Anybody who has kids, if you don't own Disney Plus, they're going to divorce you and go find new parents. They basically own all the Star Wars, all the princesses that are out there. So content is king in the future, and they own all the biggest and best content. Disney was 40% of all movie ticket sales last year. So the fundamental argument has been a screamer. In this cycle, we've been in it since $50, and we took profits on the last run up because we thought it got too expensive. But any big sort of $30-$40 pullback, you want to get back into Disney, and the no-brainer here is the high 120s. You get in there, and then you're going to be in possession for another run at, say, 155 or 160 or 200. So,
And I think we washed out quite a bit of people here today, because at almost 20 million shares, it's twice normal volume. So if you wanted to get out of Disney, it looks like you probably got out of it today.
well, and Disney's been going down for a while. It's been
Yeah.
going down for about 4 months now. So they're actually at the tail end of their correction, where somebody like an Apple or a Microsoft, we're like day 5 into the correction.
Right.
So this,
Yeah.
you want to look at the stuff that already has gone down, and Disney is one of those among the high quality batch of companies.
All right. Well, here at the midway point, John, what kind of things are you looking at, and what kind of sectors maybe, or what do you want to talk about as far as stuff that's on your radar?
Well, we're all asset class, so we cover everything all the time, long and short. We called the breakout in the Treasury bond market, and that is exactly what happened. We see interest rates on the 10-year at a minimum going to, well, our first target was 135. I said we're going to hit that in a couple months. It ended up hitting it in 2 days. So you can see the breakout here. And the interesting thing, if you look at the long-term chart, we flatlined here in bonds for 2.5 years, and finally started a big breakout the middle of last year. And since then, we've gone ballistic. So if you get, our next target is 1%, that would take us up to 175 on the TLT. And then it's possible we could even go to 0, which would take us well over 200. So don't want to buy it here. Look for a pullback.
Right.
Play bonds from the long side.
Yeah,
Don't fight the
tape on interest rates. It's a losing game.
Totally. And it's been a losing game for 30 years.
Yeah, exactly.
Bonds have been going up for 30 years, except for a rest here and there. So, yeah, that's one of our big long-term plays. Another one would be gold. We've been bullish on gold for a couple of years now, after avoiding the whole bear market that ended the end of 2017. And we think gold hits the old high at a minimum this year, which is 1972 an ounce. And then maybe spends a few months sort of churning around the old high level. So it looks like a double top on the charts across 9 years. And then eventually we break out and go to 3,000 because you have all the major central banks in the world are buying gold. It's a hedge against equity portfolios. It's a flight to safety against any kind of recession or coronavirus scares. So a lot of things going for gold. Has gone up at least 40 points since last summer. And if you like gold, you absolutely have to like gold miners. And you well know the GDX, that's the basket of gold miners, broke out here to a new all-time high. And if you like gold miners, you have to like the individual gold miners. One of those is Newmont Mining, NEM, and that has really gone nuts today. And then the other one is Barrick Gold, the world's largest gold miner, and it's at also broken out to a new high. We were buying this under 10 bucks last summer, and we're at 22 and change now. Have you got any views on gold yourself?
Well, I've been totally in sync with that. As soon as we got above 17 on GDX, it was a pretty good buy signal. And then above 22 was another buy signal. And now you're above 30. So that's another buy signal. So you've got just, hey, $244 trillion worth of world debt. And they can't hike interest rates because they could never service that debt at a higher interest rate. So their hands are tied. The Fed's got to print. The central banks are all printing. The dollar's gone nuts because it's the one-eyed man in the valley of the blind. But even that's going to get found out at some point. And gold and digital gold probably has a reasonable future to them because at some point, you just can't, have unlimited debt forever, right?
Yeah, I prefer the real kind of gold. You can't swing a dead cat without someone who's been ripped off in the Bitcoin market. So,
exactly.
I prefer the yellow stuff.
Oh yeah, no doubt.
And what's happening is that stocks are turning into Bitcoins. And the classic example there is Tesla, which went nuts, and then also the Virgin Galactic stock, Space, that also went crazy. Yeah, so gold, this is a multi-year bull market, which will go to new highs, use every dip to buy, way overextended here, and get this thing on any kind of 10% dip.
There you
Consider it a gift.
Yeah. Well, what do you think of the silver? It's been a little slow mover. I think it's because it's more of an industrial metal and people are concerned about GDPs around the world looking like dogs, dead dogs. And they're also looking at maybe this GDP, shrinkage hitting the US now. So obviously growth stinks in Europe. It's nothing to write home about. It's going to get hit in Asia. And now if it gets hit here, you got a global GDP contraction. And, maybe the industrial metal like a silver, maybe it's having a little bit more hard time getting going, huh?
Well, the real issue with silver is that none of the world's central banks buy it.
Right.
China doesn't buy it. India doesn't buy it. There's a cultural preference towards gold in all the largest gold buying countries. So gold does better in that situation. And also, what will allow silver to catch up over the long term is that every solar panel requires a little bit of silver in it. By the way, every Tesla also needs some silver. So that could be an issue once they get to major production.
So once it clears the resistance, maybe it'll get some legs at that point too, huh?
Yeah, it used to outperform gold by 2 to 1, and now it's underperforming gold by 1 to 2. So I've been avoiding silver, doing the gold plays. I mean, there's some great gold miners out there, like Silver Wheaton, which is actually a silver royalty trust. But as long as the sector is quiet, I don't remember the Silver Wheaton ticker symbol, it appears, but that's another one to play.
I got a question for you that is kind of crossing my mind. The two sectors that are lagging the other sectors in the stock market has been healthcare and the energy sector. Supposedly, you've got Royal Dutch yield going up towards 8% with this drop in the price. Do you see anything in the healthcare sector or in energy?
Well,
Healthcare's got great
healthcare, we
demographics.
are long-term bullish, and I, in fact, started a healthcare newsletter about 6 months ago, and we put out 30 buy recommendations. All 30 went up.
Mm-hmm.
So we think long-term, it's one of your major long-term bull market sectors. Short-term, it's undergoing a scare from Bernie Sanders,
Mm-hmm.
Who wants to nationalize the whole sector. So it's unlikely that Bernie gets elected. Even if he does, it's unlikely he gets anything done. So,
Right.
but you always get these scares in biotech and healthcare stocks in election year, and this one is no different. Let's see.
What about Teva, TEVA, the generic drug company?
Yeah, the Israeli drug company.
Yeah, that had a little bit of a turn.
Well, before I get onto that,
this is one in popular too.
This is one of the stocks we recommended in our biotech letter in October. We recommended it in the 40s, and we kind of moved to 75. And actually, the stock's done a split. It got a lot higher than that. So this was a double for us this year. They are the leading company in CRISPR technology, which is used for gene editing, and that one was a blowout success. Let's see, another one was Biogen, which we recommended, and we got a huge move in that. And it turns out Warren Buffett also loves this stock. So you see, you got the gap up here when they announced successful results on one of their new drugs. Another gap up here when we found out Warren Buffett was in it. So that's been a huge winner for us, over 50%.
In the banking sector, Warren has been increasing his stake in Bank of America while decreasing his stake in Wells Fargo. What do you think of Bank of America versus Wells Fargo or any of the banks?
Well, just like Rupert Murdoch was the last buyer of newspapers, Warren Buffett is the last buyer of banks. We hate banks for the long term. We don't see anything positive. They can't compete with fintech, and the only way they're going to survive is to close their entire branch network, force everyone to go online, and then buy a couple of fintech companies that'll do everything for them at 1/100th of the cost. Wells Fargo, every time you turn around, they get hit with another $100 million fine. So I don't want to touch that. And Bank of America, we're just avoiding banks completely. And yes, I know I missed a 20% move last year, but you can't catch them all. I'm looking for the doubles and triples, not the 10% and the 20%. And most of my customers are looking for the same thing. So I'm a nix on the banks.
How about Deutsche Bank? Obviously, it's a good example of what negative interest rates can do and slow GDP growth can do to a stock. I mean, it used to be at 120 before the crash. Then it was at 60. Then it was at 45. And I think the low this year was $6 and change. It's now at $9 and change. There are some people who are touting Europe is going to turn around with Lagarde in there or something. First of all, obviously that would scare you if you're a bank owner here, because if you have no interest, if interest goes low, as you're suggesting, it may really pinch the margins on the bank. but also is there value here at Deutsche Bank between $6 and $9 if you're a believer that Europe may turn around?
Well, you know, I'm not a believer that Europe will turn around. I don't think Europe will ever match American growth stocks, either on a national basis or a individual company basis. And I wish I had a, well, I suppose I could do it with the magic of charting. Let's go to a 20-year chart for Deutsche Bank, and you'll see how far it's fallen. And this is another trap you don't want to fall into, is don't buy something just because it's gone down a lot. This is a bankruptcy case. Okay, here you can see we've just since 2014 we've gone from 50 down to, let's see, get the chart up here.
That's $6.
50
yeah.
down to about 4,
Yeah,
and it's made it back up to 11. So, yeah, that doesn't look like an uptrend from me. You know, where I live, the uptrends do the opposite. They start in the lower left, they go up to the upper right. So, yeah, I'll let people smarter than me figure this one out. There are just too many. You know, if the choice is to buy, you know, Boeing at 300 and Deutsche Bank at any price, I'll take Boeing all day long, or a Disney for that matter, or Apple down another 10%.
What about the 3 big oil companies, Exxon, Chevron, and Royal Dutch? Is there value down here, or this is just
there's a value trap down here, to be
right?
precise.
Okay.
Which one you want? Chevron is probably the best of them.
Yeah,
But
best of breed. It's
they're
breaking
having
out.
a going out of business sale, essentially. Let me get off the 20-year chart here.
Too much inventory, right?
Well, it's worse than that. The world is moving to a non-carbon world. So
Right.
oil companies don't fit anywhere in that unless they start buying up alternative energy companies like crazy, which they may do. I mean, they have the management and engineering expertise to take over the entire alternative industry and have plenty of money to spare. So, you know, you have, first of all, a structural oversupply in oil, in that the United States is now the world's largest producer. We're exporting as much as we can. In the meantime, demand is falling off a cliff. First of all, because, you know, of coronavirus. China is the world's largest marginal new buyer of oil. They buy about 8 million barrels a day compared to our 20 million. So you have a basic supply demand out of whack, but they're also on the wrong side of the argument on the environment and global warming. And
Right.
I just came from Australia, and everything was on fire. One of the most amazing scenes I'd ever seen, I was by a river and I saw a herd of kangaroos run into the river away from a fire and then swim across the river in this weird hopping motion. So, you know, the environment isn't going away, and you're not seeing any new capital going into the energy industry. It's coming out at every opportunity. And you saw that again when Chevron, you know, failed on this rally, failed, and even failed here. That you're going to see a lot of failures over the next several years in oil, and we think eventually the price of oil goes to $10 or $20 a barrel, and right now we're around 50. Let's see.
Right. We're at 51.
Yeah.
I want to ask you real quick about the concept of having part of your portfolio that would benefit from a declining market as a hedge. There's a stock called DWSH. It's Dorsey Wright.
Oh, I know Dorsey Wright. I knew them when they were private.
Yeah.
What's the ticker symbol?
DWSH. Donald, William, Sam, Harry. DWSH.
Yeah. DWSH. Okay. DWSH.
And obviously it had a good day today because the market went down sharply. But, you know, the concept of putting a percentage, you know, people put a percent in gold as a hedge.
Yeah, the trouble with these specialized niche ETFs, number
Right.
one, the liquidity is terrible.
Yeah.
Number two, they underperform what they say they're going to do because of frictional costs of going in and out. And it's just too sophisticated for most investors. So, obviously they saw gold in the ETF business and went for it when it was hot, but over time these tend to fade out and close because of lack of liquidity. So
yeah, and that VXX has a couple of things where Contango is a problem because
Contango's a killer on the VXX. Yeah.
Right. Of course, today it had the big day, up almost 20% in a day, but that's also a contrarian bet kind of thing. But it's a contrarian bet that has many factors to it, and like you were saying, the average investor, it might be a little bit deeper water than they're used to swimming in.
Yeah, and this shows you the Contango over the last 9 months,
Right.
down 50%.
Right.
Sorry, in 6 months, with no increase in volatility. So
There you go.
all of that is time decay, that 50% down move. So you really have to be almost perfect on your timing
Yeah.
to get into this. We actually got in at the absolute bottom in January, caught a quick 20% move and got out. We missed the second chance to go in, which was last week. So you really have to be focused. And a lot of the people who do this, that's all they do.
Exactly.
And they play it more from the short side than the long side, waiting for these periodic spikes to come out and then play on the short side.
Yeah, I mean, it was only 48 hours of trading ago that we were at the highs. So this was a turn that happened extremely fast. And obviously you would have had to done, some come line betting to be involved in the sell side today.
Well, and the really bad thing is look at these gaps.
Yeah.
There's no way to play.
Right.
The thing opens up 20%. There's no way to get in and participate unless you want to take an incredibly high risk trade and buy at the open, and then I'll let other people do that trade. I try to leave the stupid trades for other people to do.
Exactly. Let's bang out the rest of the list in the next few minutes here. First one's going to be going back to it is Facebook.
Yeah, Facebook.
Obviously, to be honest with you, one of the things that told me that we were running out of steam was 4 out of the 5 big stocks did not make new highs.
Yeah, you got this failed top here, which is a real tell for the whole FANG area. And of course, Facebook has its own specific problems with the election and so on, and prospect of regulation. But still, that's not a chart you want to see in your portfolio.
They're still making money, but they're up at a 31 PE according to my screen, and that's a far different than the 15 or 20 was at a while back.
Yeah, absolutely, and they're still hiring like crazy too. I mean, the Facebook thinks Facebook is growing, but you just may not see it in the stock price. Amazon, I love for the long term. I think it's worth $3,000 a share.
Yeah.
On the breakup, so. And an entry point here, and actually since this is such a laggard, there actually is a realistic entry point here that's close, and that's the 50-day at 1926 and the 200-day at 1848. That might be a really good entry point, only down 100 points or so from here.
Yeah, and it went down almost 90 today.
Yeah, right. And again, that gap opening.
Yeah, Tuesdays and Thursdays sometimes are reversal days, so I wouldn't be surprised to see a little bit of a throwback after the high volume sell-off. Get a low volume throwback would not be surprising to me at all. So look around.
Yeah, but if that fails, then look out below.
Yeah, but if you're a trader, looking for some kind of a turnaround tomorrow would not be off the charts because of a high volume sell-off today, and then if the people calm people down a little bit. Next thing you know, you get a couple of people short covering, and you could get a low volume bounce.
You remember, we're only one Corona case away from another 1,000-point drop.
Oh yeah. Well, like I say, there's a lot of room between here and 3,000 that could easily be filled in, right?
Yeah. I don't follow Paycom software.
Yeah, I don't either. Let's take a look at it real quick, and it's a software.
Look at the chart.
Yeah, I would imagine if it's software, it's down today. It wasn't down too much, only 1.5%. But it is now got a high surrounded by lower highs, and sometimes that's not the best thing. It almost looks like Facebook, right? Where it came back up, can't take out the high, and now if it takes out that 290, it could be a little sayonara.
Yeah, this one, Applied Materials, we talked about earlier, actually held up surprisingly well today, only down 3%. And again, this is one of the three chip stock companies that have a near monopoly going forward. So yeah, a buy, but probably not up here.
And Cisco was already discounted pretty good, but it got discounted again today.
Yeah, this is an old legacy company. We made a fortune on this one in the 90s when everybody in the world wanted to own it. But lately it's been had a hard time getting out of the gate. And yeah, I'm glad I didn't chase after Cisco after this big earnings bounce back here. So sideways range, but right in the buy end of the range right here. By the way, you need a shitload of routers for 5G if you're going
That's
to
what I was going to say.
run a
Wouldn't that
5G
be?
world.
Yeah.
So
Wouldn't
that
that
was a
be
play
some
on
reason
Cisco.
that would be making this maybe something to pick up if it gets to a certain level, right?
Yeah, exactly. Or the market in general starts to calm down.
Yeah, because and it had already been discounted from 60 down to 40 something, so it was already down a little bit. China, FXI.
Yeah,
A lot of people saying this is a place to park some money.
yeah. Well, obviously it wasn't today, but
Mm-hmm.
this thing has been beaten up for a really long time. Let me pull up a longer term chart here just to see how low we are. Yeah, it's here's a 5-year chart. Went ballistic at the beginning of 18, has since been giving it back, and we've been in a sideways range for basically a year, and we're dead in the middle of that range. So I think things have to get worse before they get better in China. And if I was going to do China, I wouldn't do the FXI, which is largely industrial China. I'd be doing things like Alibaba.
Yeah, right.
Let's see, get a 5-year chart on that. Yeah, which has a much stronger chart, much better fundamentals.
Mm-hmm.
It's a combination of Amazon, Google, PayPal, and you name it. And another one is Baidu. Yeah, we got into this 10 years ago at $12 and got out a long time ago. I mean, it got expensive a couple of years ago, but 290 down to 100 kind of looks like an entry point down here. So if you do want to get a end of Corona play, Baidu is probably a really good one, and Baba is the other.
And what about Tencent? What do you think of that?
I don't really follow that much. The added value of the company isn't that great, so
Right.
we try to avoid it.
All right. The last one on the list here is Twitter, TWTR.
Yeah. Well, let me get off the 5-year chart and go back to 2 years so it's more understandable. Let's see, 2 years. Yeah, we haven't touched this thing. I know we also have a Mad Hedge Technology letter. They've been trading these ranges, but for our main global macro letter, we haven't touched it. So almost in the middle of a range, held up surprisingly well today, but then it's didn't have much to give up. It's gone nowhere for a couple of years and has already had a nice $10 move. So nothing to do here.
On a couple of other 5G companies like Qualcomm, Do you see, you want to take a look at that and give a little opinion?
Yeah, one last thing on Twitter.
Sure,
If Donald Trump loses the election, this company goes to zero. I mean, he probably generates half of their traffic. So that's another reason to stay away.
Either that or he starts listening to Barr, right?
Or, he has one too many cheeseburgers. It could be any of the above.
So anyway, yeah, on the 5G, let's look at a couple of those and see what you think, because they're still above their
This
moving
is
average.
not a new story, Qualcomm, but there's really no new stories involving 5G. So yeah, great stock, had a great run, kind of a head and shoulders top there on the chart. So
Right.
again, all these guys probably need a rest of a couple of months before they get back into the driver's seat.
And Corvo, QRVO.
Okay, QRVO. Yeah, this is something our tech letter covers, not me personally. Obviously, down $25 this year isn't great. So just looking at the chart, I wouldn't touch it.
Yeah, it looks like it could fill that gap, but somewhere around that 80 to 90 area might
you
make.
got more than a double last year. So, even though I don't know the stock, I certainly know the sector and the chart.
And the last one just was Skyworks, SWKS.
Yeah, this is the Apple sort of spin-off. It's the major part supplier for Apple. So it's basically Apple on steroids.
Mm-hmm.
Got a double last year, and also looks like it's topping out as along with Apple. So, 200-day moving average at 90, that makes a lot of sense.
Mm-hmm.
But nothing to do here.
Many of the stock charts have a similarity in that they are in uptrending 200-day moving averages, but they're very extended.
Right.
And so the idea of a correction, and like you were saying on some consolidation period, could be what the future holds, huh?
Yeah, when the whole market gets like that, you want to run a mile.
Yeah, or go to holiday or something.
Yeah, go to Australia.
All right, well, we're coming to the top of the hour, John. So please, again, just reintroduce yourself to the newcomers. And also, if you have an invite on something that you're doing, this would be a good time to offer it.
Yeah, I'm John Thomas, the Mad Hedge Fund Trader. You can find me at madhedgefundtrader.com. We have a free research product for people who just want to come in and get a free sample. Just go to our website, madhedgefundtrader.com, sign up, get the free research, and you'll get a free special report on my outlook on all asset classes for all of 2020. Again, we were up 56% last year. We're average around 34% over the last 10 years, and we look forward to working with you.
Okay, that sounds great. And again, thanks a lot for showing up, John, and going through these stocks, and of course, offering your own ideas out there as well. And everybody should try to take advantage of contacting John and see what he can do for you up there. Right now, what I'm going to do is send it back over to David. I'm Jim Kenney. If you'd like to get our weekly update that I issue, just simply go to optionprofessor@gmail.com. We'll put you in the queue, and you'll be getting weekly updates on what my thoughts and my opinions are. Okay, David, back to you.
All right, thanks, guys. Lots of great info today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast network. You can also go to TimingResearch.com to get access to this or any of the past shows or reports. And so this was a special Monday episode, but we'll be back tomorrow with the normal Tuesday episode of Analyze Your Trade. So Jeff Gibby of Metastock will be joining us for the first time for that episode, and that will be at the normal 4 p.m. Eastern time on Tuesday. So you can go to TimingResearch.com/live to get access to that event. And I just want to thank my guests again for today, John Thomas of Mad Hedge Fund Trader and Jim Kenney of OptionProfessor.com. Thanks, everyone.
Thanks, David.